Okay, let's dive right into this. Welcome to today's explainer, Business Moats, Why Some Companies Are Almost Impossible to Beat. We're going to unravel one of the most fascinating mysteries in the entire financial world. Have you ever wondered why some companies manage to stay just incredibly successful for decades, completely dominating their industries and raking in massive profits, while others seemingly amazing companies just disappear? The reality is, a lot of businesses can build a great product for a year or two, but only a tiny fraction achieve true multi-decade dominance. Today, we're going to map out exactly why that happens. We are looking at the secret structural defenses that the world's most successful businesses use to become almost impossible to beat. To really understand this business mystery, I want you to put yourself in the shoes of a medieval general for a second. If you had to attack a castle, which one would you honestly choose to invade? I want you to genuinely think about the defenses, the vulnerabilities, and where you'd want to spend your time, your money, and your resources trying to break through. So, you're looking at Castle A, which has this huge moat and super tall walls, and then there's Castle B, which has absolutely no moat and its gates are just left wide open. Obviously, Castle B is the target, right? Any invading army would just march right in without a second thought. Well, in the modern economy, businesses operate exactly like these castles. If a company is highly profitable but leaves its gates wide open, it's completely undefended. Almost immediately, copycats, overseas dropshippers, or massive tech conglomerates are going to march right in and steal its treasure. To survive the brutal reality of the free market, a business absolutely has to build protection. Section 1. The Company Mystery. Consider heavy hitters like Apple, Disney, and Coca-Cola, or Costco, Visa, and Nike. What do all of these companies actually have in common? What makes these specific giants so incredibly difficult to unseat? Now, it's really tempting to just shrug and say, well, they have cheap prices, or, they're just big brands, or everyone loves their products, but it goes structurally way deeper than that. They all share this hidden architecture that actively keeps their rivals locked out. So the crucial point here is understanding the business moat. A business moat is a competitive advantage that protects a company from competitors. The legendary investor Warren Buffett actually popularized this term, economic moat, to describe exactly this phenomenon. Just like a physical moat filled with water protects a physical castle from an attacking army, a business moat protects a company's profits and its market share from attacking competitors. It is literally the ultimate shield in the corporate world. And here is exactly why the smartest investors in the world care so deeply about this concept. On one hand, you have Business A. Because it's easy to copy, competitors rush in, triggering these brutal price wars. The company suffers from severe margin compression, loses customers, and profits inevitably just collapse. On the other hand, you've got Business B, which has a strong moat. It wields real pricing power. It keeps its customers and it keeps its profits safe from invaders. Ask yourself, if you had to lock your money away and hold on to just one of these businesses for 20 years, which one would you choose? It's Business B, every single time.
Moving on to Section 2, the 6 defenses.
Our first defense is the brand moat. We see this with giants like Coca-Cola, Nike, and Apple. There are literally hundreds of cheaper sodas, running shoes, and smartphones out there, right? So why do people willingly line up and pay a premium for these specific brands? It's because the brand itself is lodged deep into the consumer's mind. Take the classic blind taste test, for example. Time and time again, consumers actually prefer the taste of Pepsi when they're blindfolded, but they overwhelmingly choose to buy Coca-Cola in the store. Why? Because the brand identity, the feelings of nostalgia, and the trust are so powerfully ingrained. That psychological connection acts as a massive, invisible wall. Now, what's really interesting is our second defense, the low-cost moat, perfectly exemplified by Costco. Costco's entire business model is designed to sell products cheaper than literally anyone else. But the moat isn't just the low price, it's exactly how they pull it off. They leverage massive economies of scale and immense negotiating leverage with their suppliers to just drive costs into the floor. Plus, they actually make the vast majority of their profit from membership fees rather than huge markups on the products themselves. That makes it virtually impossible for a new competitor to attack them. If you try to fight Costco on price without that membership revenue and scale, you'll bankrupt your own company before they even feel a scratch. Okay, our third defense is the network effect. This brilliantly illustrates how some companies become genuinely unstoppable. Think of Visa, YouTube, or Instagram. This moat basically operates as a giant flywheel. Step 1, you get more users. Step 2, because there are more users, the platform actually becomes intrinsically more valuable to everyone who's already on it. Step 3, that increased value attracts even more users, spinning the flywheel faster and faster. Every new user actively improves the product experience for the existing users. Ask yourself, what happens to this moat if everyone suddenly leaves? Well, it collapses. But because everyone is already there, it's basically impossible for a new competitor to convince billions of people to move somewhere else all at the exact same time. Moving on to defense number 4, switching costs. This is also known in the industry as vendor lock-in. Let's say your entire school or your entire massive corporation runs on Microsoft Word and Excel. Would changing to a new system be easy? Absolutely not. The moat here relies on friction and the literal financial cost of retraining a workforce. The sheer hassle, the months of training time, the lost files, the absolute pain of migrating away from entrenched products creates this massive defense. Even if a competitor comes along and makes a slightly better, cheaper product, enterprise customers won't switch because the headache and the financial cost of leaving is just way too high. Defense number 5 brings the law into the equation: patents and innovation. If you're a pharmaceutical company that spends billions of dollars inventing a blockbuster drug like Humira or Lipitor, the government actually grants you a patent. This acts as incredibly high, legally enforced castle walls. Competitors are legally banned from simply copying your highly successful formula. It forces rivals to either spend their own billions to invent a completely unique solution or just give up. Now, of course, this moat does have a ticking clock. Investors closely watch what's called the patent cliff. That's the terrifying moment those legal walls expire and generic competitors suddenly flood the market. The final defense, number 6, is unique assets. This is when a company possesses intangible assets that are literally irreplaceable. Think about it. Disney has exclusive rights to its magical characters like Mickey Mouse and the Marvel heroes. Other companies might own prime legacy real estate locations or exclusive broadcasting rights for major sports leagues. These things cannot be replicated at any price. You could have $1 billion in cash sitting in your bank account right now, but that still won't legally buy you the right to build a competing Mickey Mouse theme park next door. Owning a unique, irreplaceable asset creates an entirely impenetrable defense. Which brings us to section 3, when moats dry up. Because look, history tells us pretty clearly that even the greatest, most heavily defended empires can fall if they get lazy. In decade 1, you had companies like Kodak, BlackBerry, and Nokia experiencing absolute dominance. They ruled their markets, they seemed completely untouchable. But in decade 2, the sands shifted. Technology rapidly evolved. Take Kodak, for example. The deep irony of Kodak is that they actually invented the very first digital camera, but they deliberately buried the technology because they were terrified of cannibalizing their highly profitable film moat. And that fatal mistake led straight to decade 3, the fall. Their moats dried up entirely because customer preferences completely changed and they just refused to adapt. The lesson here is crystal clear. A moat is not permanent. It has to be actively maintained and dug deeper every single day, or the castle will eventually fall. Section 4, the Moat Detective Blueprint. So, before you ever decide to put your hard-earned money into a company, you must run it through a rigorous mental gauntlet. You have to ask yourself directly, what exactly protects this company? Can competitors easily copy what they do? Will this moat still powerfully exist in 10 years, or is it already starting to dry up? Evaluating a moat requires forward-looking thinking. You can't just look at past success. You have to project the strength of those walls into the future. And only when you can confidently answer those questions should you finally ask yourself, would you actually invest? I want to conclude today's explainer by throwing down a bit of a challenge to you. Think of your absolute favorite company right now, the one you buy from the most. Now tell me, what is its biggest moat? And more importantly, will that moat still be protecting their castle in 10 years? Let that forward-thinking question completely change the way you look at every business around you. Thanks for joining me on this deep dive, and keep your eyes peeled for those moats out in the wild.